Hey, it's Miss Kelly Michelle. Welcome back to my channel. Today I am going to take you along with me because I'm going to look at two properties. These are going to be two wholesale properties that are available right now, and I'm going to check them out to see if I can use them as long-term rentals. So I'm going to take you along, show you the properties, and then we'll come back and I'll show you or give you the numbers. What the cap rate was or is for these particular properties. Now these are estimated numbers because I am not home to get the actual information that I need. I'm just trying to get an idea of if these are good deals or not. I still need to realistically get the rent rolls if there are any. I'm not sure how long the properties have been vacant, so there may not be any. I also still need to look at the expenses for sure on the property as far as how much they run, and I could simply call the utility companies and just get an idea of how much those utilities run as far as the water, sewer, and trash, because those will be potentially the only things I cover, but the tenants may cover it, because I do have properties where the tenants do cover those costs, right? But I want to include them into this equation just so I have a estimate, okay? Then also I need to get some accurate comps, because I'm using Zillow and I use the Z estimates. That's not quite accurate, but if I get some actual comps from the MLS, that's going to give me a more solid number. So understand that what I'm about to give you is just a example of how you can run the numbers down and come up with your cap rate to determine if it's a good deal or not. Now, for long-term rentals, the good cap rate, it will be between 5 and 8%. Let's run down the numbers. For the first one, you're going to see me look down because I am looking at the paper I wrote my notes on to go over this with you, okay? All right, so when I looked up the rental rates in that area, the rent could, for a 2-bedroom, 1-bathroom house, is $984, okay? All right, they have the price for, or the first property for sale for $65,000. It needs about $12,000 of work still left into it. The Z estimate told me that that type of house in that area really is worth $54,900. Okay, so let's go over what our net operating income would be. I am taking the income from the property for 12 months and I'm subtracting out the utilities that I would be responsible for. So that would be more likely sewer, water, and trash, but I may not be responsible for all of those things, but I'm going to include it in this example just in case. And I'm going to also subtract out the mortgage, because the mortgage includes the loan payment, the insurance, and taxes. So all of that will be included. So I'm adding all of those up for 12 months and we're going to subtract everything out. So the net operating income that I received, $3,108. $3,108 is the net operating income. That's an estimate. And the price that I use as far as the market value is $54,900. When I take the $3,108, divide that by $54,900, I am getting 5% cap rate. So that's pretty good. That's a good deal. I'll just have to go back and solid up these numbers, make sure I get more accurate numbers, and if it's still 5%, then we're in a good shape to move forward on this property if I choose to do so. Now let's look at the next property, the second property that we toured. Now that one is about 2 blocks away from the first one, so the rent rate is still going to be the same, $984. They have that priced at $70,000 for sale, but the Z estimate also said that it's worth $70,000. It needs about $5,000 worth of work into it. So let's take a look at that. I'm using the same utility expenses as far as the $300 for utilities. I'm using that same number. And I changed the mortgage amount to $560 just because it's a higher price point for this particular property, right? All right, so when I took a look at the net operating income, the estimated net operating income, I got $1,488, okay? So I took that and I divided it by 65,000. I used 65,000 because they have it for sale for $70,000. It still needs about $5,000 worth of work put into it, so I just reduced it down to $65,000. So that gave me a cap rate of 2%. That will not work. So either I'm going to have to go back and negotiate the price down so we can get this cap rate in between the 5 and 8%, or we'll pass on the deal. So that's how you take a look at the cap rate and understand when a deal is a good deal versus a not so good deal. So now that we have looked at those two properties, let's talk about one way I could potentially finance these deals, okay? So they are good deals. If I want to move forward, I could do that again after getting some actual information as far as the rent roll regarding the actual value of the property, getting some actual comps from the MLS to determine that, all right? So those are things that still would need to be done and could change my cap rate. Keep that in mind. All right. But one loan option that is out there for investors is called a DSCR loan. Now, you probably have heard about this type of loan, but this loan basically is for people to buy investment properties, and it does not rely on your personal income or your personal credit. They are only looking at the cash flow or the revenue potential for the particular property. Now, you can get anywhere from a 1-bedroom up to any type of commercial property, but you have to keep in mind that you do have to put down at least 20%, if not 25% on the properties, right? That is one thing that you can do if you feel like you don't have a strong enough history as far as going off of your personal income or personal credit. This is an option for you, okay? You can get a loan based off of the cash flow of a property. So I'm going to look into this a little bit more, but this is what I've learned so far, okay? The DSCR basically stands for Debt Service Coverage Ratio, and they're looking for at least a 1.2, okay? Now, if you get a 1.2, then you're good to go, and they would potentially loan on that property. If it's higher than that, that's even better. But if it's lower, then no, that's not going to work. So what does this 1.2 number mean? The income received from the property is 20% higher than any debt on the property. So the debt would be any types of mortgages, insurances, taxes, any miscellaneous expenses, repairs, whatever the property needs on a monthly basis. You're making 20% more than that. So that is a good thing. You're going to get a loan on a property that you automatically know will be cash flowing and bringing you profit, because if it didn't, the lender would not loan on this property, okay? Now, the benefit of it is that you can potentially get a higher loan amount because it's not going off of your credit or your income you receive personally. It's going off of the income from the property and versus the debt service. So you could potentially get more of a property. Okay. So instead of getting that $300,000 property, you may be able to get $1 million property as long as you have that down payment. So you also have to keep that in mind. You have to have your down payment, and you need to have any additional closing costs that goes along with that. So these are things you have to consider. Now, the downside of this type of loan, this DSCR loan, is that it may require more documentation, more analysis, because the lender wants to definitely make sure that this property is cash flowing and that you will be able to pay off all of the expenses of the property and still make money, okay? Which is still a good thing. They're looking out for their interests, but in the end, they're still looking out for your interests as well. If you're interested in this type of loan, I would suggest you do some more research about that. You would have to find a lender who specializes in these type of loans, which is, they're called, remember, the DSCR loan. Okay, debt service coverage ratio. All right, that's what it stands for. I'm going to look into this a little bit more, see if this is something I'm interested in, if I decide to pursue these properties. The other thing you can consider is that you don't have to just get one property. You can get multiple properties. The lenders will loan on multiple properties with this type of loan. As long as you have that down payment and it meets their ratio qualifications, then you're okay. All right. So you don't have to wait to go get another property. If you have the money to do it, you can go do it. So I could potentially get these 2 single family homes. And if I have enough money to put down on a commercial property, I could potentially go get a commercial property as well. So you have to do what fits within your means and within your budget. If you feel like you don't have that much of a down payment, then go for the smaller properties where you can afford to put down that 20 to 25% down payment plus any additional closing cost that may be associated with purchasing the property. All right. But if you have bigger pockets and you want to put down on that commercial property, do that. Okay. Again, you can always start smaller and work your way up. Okay. You don't have to start all the way at the top if you're not able to do that yet. Start somewhere and build upon your portfolio. It will continue to grow. Okay. All right. I hope that helps you guys. Now, I provide information like this as well as other real estate investors in our Rental Revenue Builders membership. Okay. So if you are not a part of that membership, click the link below in the description, check it out, and see if that's something you want to be a part of. We talk about everything that will lead you to building your rental portfolio. from the beginning of your buying criteria and figuring that out, all the way to scaling your portfolio. We have people in here, investors that are experts at hard money lending and crowdfunding and getting private lending, and they tell you all about that. So we are gradually adding to this membership every single month. We have another investor who specializes in commercial properties. We have a wholesaler who can tell you about how to get discounted properties. We have myself who tells you about all types of rental properties, short-term, midterm, and long-term rentals, right? The purpose is for you to build your net worth. Okay, we want you to build your net worth with rentals so that you can secure your future and the future of your family. Even if you're not still here on this earth, your family can still benefit from what you have done with your rental portfolio. So make sure you check out the Rental Revenue Builders membership. Again, we're adding new content every single month to it, so you're always getting more and more information that will help guide you in the right direction. All right, make sure you like and subscribe.